Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to our podcast channel, your Tax-Free Life podcast channel. And this is episode 102 of your Tax-Free Life. And today is going to be a very interesting one. On Saturday, I went ahead and did a webinar for all my clients and followers, regarding the impact of the coronavirus on retirement accounts. So I decided to name this podcast, has the COVID-19, the coronavirus 19, cost your 401k to become a 201k? Again, has the coronavirus cost your 401k to become a 201k, which is something that I'm getting calls from clients every single day regarding this issue. Now, this is something that I've been talking about for many years. And this is something that I mostly talk about and have discussions with clients and with many of you on an ongoing basis just about every single week. Whether I'm doing a podcast, I'm doing a seminar, I'm doing a webinar, I'm writing a book, I'm actually creating a digital retirement distribution plan for all of you, and this is going to be very instructional in nature, it's very educational in nature. But this is something that I see often, and the challenge is that, for the past 10 years, we have been going through a bull market, which is the longest bull market in history. But I'm going to kind of put everything in perspective for all of you, because information without education always leads to failure. And before I give you some of the stuff that I covered at the webinar on Saturday, I want to touch upon some numbers that I went ahead and calculated last week, and I went ahead and revised again today, just for you to get an idea of what the market can do for you and what the market can take away from you and from your family and from your retirement life. So if we all go back to December of 1999, that was the first time in U.S. history that the stock market hit 10,000. Now, obviously, we had a really bad decade at that point in time because it went up to 14.7. Then it dropped again during 2008. And then obviously, we all know what happened during 2008, 2009. So at the end of 2009, 10 years later, the Dow was back again at 10,000. So we call that the decade of nothing. And the same thing happened with the NASDAQ, except that the next time that, the NASDAQ in 1999 closed for the first time at 5,000. And the next time that the NASDAQ closed at 5,000 again was 15 years later, pretty much in 2015. So pretty much a NASDAQ went on a hiatus for a 15-year period. Now, if you're in retirement, how many 15 years or periods do you have in which your money does not grow? Or how many decades do you have? I would argue none of it. You should not have a single decade in which your money's not going to grow. But going back to my calculation, in 1999, the market closed at 10,000 for the first time. And then as of a few days ago, the market was at 23,185 after taking a tremendous amount of beating. And I'm not including what happened on Monday, on this past Monday. But so 10,000 was in 1999, 23,000 was 23,185 to be exact, was a few days ago. Over a 20-year period, the average rate of return for that 20-year period was 4.29%. And that is accounting for the biggest and the longest bull market in the history of our country. Now let's go ahead and do the same comparison back in 1999, where the market was in January. or actually I would say probably 3.5 weeks ago, the market was at 29,343. So if we do the same calculation, the 10,000 at the end of 1999, and 20 years later at 29,343, the average rate of return was 5.53%, 5.5%, okay? And then if I go back to 1900, and I want to count for the last 119 years, since the beginning of the time that we started to keep track of the Dow and the numbers on a daily basis. In 1900, in 1900, the Dow closed at 65. Fast forward 119 years later, and again, I'm using the numbers from a few days ago, where the market was at 23,185. Over 119 years, the average rate of return was 5.06. So if I were to average all of those, and by the way, today as I'm doing this podcast to you, the market is at 20,235, not 23,185, not 29,343. It is at 20,235. And if I do the same 10,000 calculation over the last 20-year period, the average rate of return for the market is 3.59%. What I'm trying to tell you with all this is that the vast majority of you, all of us at some point or another, have been putting all our eggs in the stock market and not realizing that if you're going to bet your money in the stock market where there's a lot of volatility and there's a high probability that in a matter of 3 weeks you have actually lost, and this is a fact, all of the gains that you had in 2020, all of the gains that you had in 2019, all of the gains that you had in 2018, and some of the gains in 2017. If in a 3-week period your retirement account goes from being a 401k to being a 201k, then do you really have a retirement account in place? I would argue not. So one of the things that I try to do for all of you is kind of wake you up to the fact and allow you to see your financial world through a telescope as opposed to a microscope. But if I average all of these numbers together, we don't even get a 5% average rate of return in the stock market over all of these years, regardless of how far back do you want to go. So that's something that you need to pay attention to, because at the end of the day, the definition of insanity is doing the same things over and over again while expecting a different result. And many of you are still sitting on your retirement accounts. Many of you have not taken any defensive action. Now, you should have taken these defensive actions when I started to talk to you about them over 2 years ago. You know, not having all your eggs in one basket. Putting some of your retirement funds into accounts where you have the principal protected, and we'll talk a little bit about that in a few more minutes. But at the end of the day, if you continue to do the same thing over and over again and you expect a different result, chances are you're going to be a financial failure in your life. Now, when I talk to many other clients that I deal with on an ongoing basis about this, they say, well, Bert, the last 10 years I've been doing really well. And my account values have been doing real well. And my answer to that was always the same. Even a broken clock is right twice a day. Let me repeat that. Even a broken clock is right twice a day. And the challenge for many of you is that even a monkey could have done really well in the last 10 years. Because you can blindfold a monkey, give him a dart, have that monkey throw that dart against a wall, and the rate of return was going to be adequate for that 10-year period. Now, how is your monkey doing in the last 3 weeks? How are you doing in the last 3 weeks? Have all of your gains have been evaporated? Have you lost 20, 25, 30, 35, 40% of your money in the market? See, what people fail to realize is that you need to make certain that you protect your retirement assets. And you need to protect the downside of those retirement assets from a business perspective. So let me give you a little bit of a historical data, which is something that I covered at the webinar. And by the way, for those of you that may be interested in listening and watching that 1-hour webinar, please feel free to reach out to me. You can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, @gablestaxgroup.com, and I'll be more than happy to send you the link so you can watch that entire webinar at your convenience. Now, let's take a look at the S&P 500, and let's look at bear markets. And I'm going back between 1929 and 2009, which was the last time that we had a bear market up until right now. Now, historically, a bear market is going to occur every 5 years. And the average decline on a bear market is going to be approximately 39%. Now, usually bear markets are going to last about a year and a half or, 1.5 years. And the time to break even after a bear market for the vast majority of investors and advisors is going to be around 5.2 years. And that creates a chain reaction. Because if you dropped on a bear market at least 20%, more than likely it's going to take you 5.1 years to get back to where you were at 5 years ago. So not only are you losing that money, but you're also losing the opportunity cost of that money, because inflation, number one, is not tax deductible, and inflation continues to impact everything that you do every single day of your life. So you're never going to recover those inflationary losses when you go through a bear market. Now, what many of my clients have done, and this is a reason why I wanted to do this podcast today, is I've been getting a lot of calls. Because the big question is, Bert, what am I going to do with my retirement assets? I am down 35, I'm down 40%. What do I do? Do I sit it out, or do I do something about it? Well, one of the challenges for many of you is that if you're in a boat and the boat is sinking and is taking on water, do you start plugging the holes right away, or do you wait until the boat totally sinks before you try to plug the holes? By that time, it's going to be way too late. Now, some of you should have started plugging holes 2 years ago, a year ago, 6 months ago. For some of you, it should have been 3 weeks ago. But yet, you're riding this downhill. It's just like riding a bicycle. Going downhill is very fast. Now, trying to climb a hill is a totally different ballgame altogether. So basically, what most of you have done with your retirement assets is you have actually jumped out of this retirement airplane without a parachute. And you're suffering the consequences today, and you're going to pay the price dearly for everything you've done. Now, for those of you that have been doing really well with your retirement accounts for the past 10 years prior to this bear market that we're in today, I have a thought for you. Only when the tide goes down will you know who is swimming naked. See, most of you were doing very well. You were getting a nice rate of return. Like I said, even a monkey could have done that. But now, over the last 3 weeks, we're in bear market territory, and we have no end in sight at this point in time. And now you're looking at yourselves, and now you're realizing that because the market tides have gone down, now everybody realizes that you have been swimming naked. And what I mean by swimming naked is not having any protection whatsoever on your retirement assets. And you know what? If you are someone that is going through those issues right now, shame on you. You should have known better. You should know that you should not have all your eggs in one basket, and that you need to protect the principal of your investments. And by the way, for those of you that still don't believe what I'm telling you today, there's a big difference between an average rate of return and an actual rate of return, and this is something you got to pay attention to. You better pay attention to this, because if you don't understand what I'm about to tell you, it's going to take you even longer, and for many of you, you're never going to recover from the market losses that you're suffering today. So let me give you an example for you to ponder with. If you have a 50% loss in the first year and a 50% gain in the second year, the average 2-year rate of return is 0. And that's exactly what the mutual fund companies and the investment companies are going to be reporting on an annual basis. So if you have a 50% loss and a 50% gain, the average rate of return for the 2-year period is going to be 0. But now, like Paul Harvey used to say, the rest of the story. So why don't we actually put numbers to this equation that I just walked you through, and let's see what your actual rate of return is. So let's take a look at a $100,000 investment. In the first year, you have a 50% loss, so you're down to $50,000. In the second year, you have a 50% gain, but now that 50% gain is on the $50,000 that you ended up with at the end of the first year. So now at the end of the second year, you're up to $75,000, but you started with $100,000 2 years earlier. So that means that although your average rate of return was $100,000, your actual rate of return is a negative 25%. With these, I can give you all kinds of exercises, but I don't want to go and ponder this point anymore. All I'm trying to tell you is that it's a lot easier when the market goes down a lot faster than it is to recover from a market crash, a bear market, or a market loss. Now, how long will it take for your account values to recover? Well, let me give you an exercise here as well. And the question is, how long does it take to break even after a large financial loss, which many of you are actually going through today? So let's say that your average portfolio, your average retirement account is down 40%. In order for you to get back to even at the end of the first year, you need a 67% rate of return in that year for you to recover that 40% loss that you had in that year as well. So therefore, it takes a much higher rate of return to break even from a 40% loss. Now, I have never seen a 67% gain in the stock market. So normally, what if I were to say to you, well, it would take 8% for you to be able to recover from, if you're getting an 8% rate of return on an annual basis after a bear market, that's a pretty good rate of return. The challenge with that is that if you have a 40% loss and you're now gaining back at 8% per year rate of return, it's going to take you 6.6 years just to get back those losses that you incurred at 40% 6 years ago, or pretty much almost 7 years ago. So once again, protecting the downside of your retirement accounts is very, very critical. Actually, if you look at the S&P 500 for the last 20 years, notice that in 2000, the S&P 500 was at 1527, and then it went through a steep decline at that point in time. And by 2003, and this is again from 2000, the S&P 500 had lost 49%. The next time that the S&P 500 reached the peak again to be fairly even to where it was in 2000 was actually in 2008. So therefore, you had a long period of steep climbing year by year just to get back to where people were up in 2000. So that's actually an 8-year crawling back year after year to get back to even. And again, I'm not factoring in fees. I'm not factoring in taxes that you may have had to pay if it was on a traditional mutual fund account. I am not factoring in anything else that may be aligned with some of the investments that each and every one of you may have from a business standpoint. Now, obviously, the question is, well, what am I going to do now? And for some of you that have actually liquidated your accounts and have gone to cash, okay, so you are now absorbing those losses, and that may be okay. There's nothing wrong with doing that. I think the big question for all of you is, when do you get back in? When do you get back into the market? Because the market is going to be very volatile. You may have a day where the market goes up 1,000 points, And then the next day, as it did a couple of days ago, the market went down 3,000 points, almost 3,000, 2,997 to be exact. So the question for many of you that have gone to cash is, when do you go back in? Most of you, what's going to happen is you're going to wait it out. So by the time you get back into the market is probably going to be up 10, 15, 20%. So because of the fact that you pull the trigger so late, that means that you actually gave away a recovery of 10, 15, 20% for that period while you waited out to make a determination when would be the right opportunity for you to get back in the market. Now, I think that's where having a principal protection program in place would be very, very suitable for all of you. And think of it this way, what's better, a hammer or a screwdriver? Well, the answer, it depends. It depends what it is that you want to do. And when you look at principal program, think of it as going to Baskin-Robbins for ice cream. They have 31 flavors. For each and every one of you, every flavor is going to be different. So there are many different ways that you can carve out a principal protection program in order not only to safeguard your retirement assets, not only now but also in the future, but also to help you recover as many of those losses as you possibly could. Now, one of the products that I recommend to my clients, and again, it depends on your circumstances. If you're 60 years of age, I would argue that 60% of your retirement assets should be in a principal protection program. If you're 70 years of age, it should be 70%. If you're 80 years of age, it should be 80 to 85%. If you're 50 years of age, it should be at least 50%. So it all depends. Now, also depends when do you want to have access to your money? When do you plan on retirement? What is going to be the retirement income necessary for you to maintain your standard of living? All of those things are taken into consideration to determine which principal protection program is going to be the most suitable for you. But one of the products I do often recommend to my clients is known as a fixed index annuity. The beauty of a fixed index annuity is that it doesn't, your principal never goes above that red line where now your principal and interest is at risk. So therefore, in a fixed index annuities, you have guaranteed principal protection. You participate in the upswings of the market through a way to do that. Now, although your money is not invested directly in the market, it is tied to different indexes. You and your advisor can pick and choose from one year to the next, but your principal is guaranteed. Now, some of these principal protection programs offer a variety of other options, like, for instance, a long-term care rider. If you don't have any long-term care and you're concerned about that, then some of these principal protection program or fixed index annuities provide for a long-term care rider. Some of them provide for guaranteed income for life that you cannot outlive, similar to what you would get from a Social Security benefit or a guaranteed pension from an employer. So with some of these products, you can actually create your own guaranteed pension if you so desire. The most important thing about a principal protection program is that your principal is always guaranteed. Not only that, but once the interest is credited, so let's say that you put $100,000 into a fixed index annuity, and at the end of the first year, that fixed index annuity grows to $110,000. Now the new guaranteed amount is the $110,000, not the $100,000 that you started with. So any principal plus any guarantees that are credited to your account at the end of that year, the anniversary year for your specific account, now becomes totally guaranteed moving forward. So even if the market drops 30% in the year after you gained your account value of $110,000, you will stay at $110,000. So if you think about it from a business standpoint, and this is something that all of you should look forward to, zero should be your new hero. Therefore, if you do it the right way, then the worst you can do is zero in a given year. You'll never suffer a loss. Think of going to Vegas and sitting at a blackjack table. For those of you that know anything about blackjack, and I used to live in California, so I used to go to Vegas with my family often. When you sit at a blackjack table, there are three choices. You can either win, you can lose, or you can push, meaning that you tied the dealer, so you push and you stay put. Now, what if you're sitting at a blackjack table and the dealer says to you at that point in time, well, I'm going to go ahead and change the rules of engagement for this table moving forward. The old rules was that you could either win, lose, or push. The new rules dictate that you can only win or push, but you can never lose. Here's a question I would ask each and every one of you on this podcast. How long do you think you're going to sit at that blackjack table? In my case, I'm going to sit at that table for the rest of my life. Because if the worst that I can do is push, and other than that I can only win, I'm going to stay at that table for the rest of my life. They're going to have to feed me at that table. They're going to have to bathe me at that table. They're going to have to bring me all my IVs and give me my intravenous vitamins at that table, because I am moving nowhere from that table. Well, those are the advantages that a fixed index annuity can bring to the table for all of you, depending on your goals and objectives. And they have different maturity periods. I'm not going to go into that right now because for every person is different. But this is something that you need to consider, because at the end of the day, we do have a tendency to kind of protect, the people that we love and the things that we love. So we buy life insurance in case of a premature death to protect our families. We buy auto insurance in case we get into a car accident so we can protect the value of our vehicles. We buy homeowners insurance in order to protect the value of our home in case of water damage or fire or theft or whatever it may be. Most of us purchase disability insurance in order to protect our ability to wake up every single morning and go out and earn a living, so we buy disability coverage. Many of you actually purchase long-term care insurance in order to protect the risk of living with a disability, which is going to happen for the vast majority of you, at least 70% of you in the future. So if that is the case, if we spend so much time protecting the people that we love and protecting the things that we care about and the assets that we love as well, why would you not be protecting one of the most important assets in your retirement? Your retirement accounts, your 401ks, your TSPs, your IRAs, your traditional mutual funds. Why would you ever want to put all of those assets at risk for no reason whatsoever? Why? Because you thought that the market was going to continue to head north? And by the way, this is coronavirus. So, this is something that has just happened just over the last couple of months. But at least in the U.S., we started to identify it back in January. And I'm glad that in many different ways, we stopped the travel from China to the U.S. because that's given us a little bit of a breather. Doesn't mean that we're out of it, but it's given us a little bit of a breather. So if you want to protect your assets moving forward, knowing that life happens, things are going to happen to you in your life from a financial standpoint, that, shame on you if you don't have it protected. See, when you look at your retirement life, you have to look at it through a retirement risk management approach. And I call it the Fatal Four. And the Fatal Four is making certain that you can protect the risk of premature death and dying too soon, that you can protect the risk of living too long and running out of money before you run out of life, that you can protect the risk of living with a disability like long-term care, Alzheimer's, all the stuff that's going to happen to all of you in the future. And then last but not least is protecting your retirement assets from eroding factors. And for me, the definition of an eroding factor is anything that can have a negative impact on the use of your money. So what do I mean by that? Well, taxes, inflation, stock market volatility as the one that we're seeing right now and we're living through right now, interest rate volatility, propensity to consume, lawsuits, anything that can have a negative impact on your life, if you're not protecting those assets, then shame on you. Don't call me and start blaming you and say, Bert, why didn't you tell me about this? Because I've been telling you about this for 2 years. Some of you, I show the door, but you want to go through the wall, and that's okay. At the end of the day, it's your retirement life. But many of you are crying today. As a matter of fact, I would argue that some of you may not even want to open your account statements when they are coming in now every single month. But there's a way that you can repair this. And there's a way that you can protect your assets moving forward while gaining the confidence that you're going to be recovering every single year as long as the market does something positive, knowing that if next year the market recovers 10%, but the year after that it drops 20%, it doesn't have a negative impact on you and your retirement assets because you're not going to participate in the losses as well. As always, if you want to get a hold of me, please feel free to reach out for any questions, 786-766-1042. You can also send me an email at Bert, B-E-R-T, at gablestaxgroup.com. And always remember that my goal, sometimes I have to be hard with all of you because, again, the definition of insanity and so forth. But my number one goal for each and every one of you and your families is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So again, once again, thank you for giving me a few minutes of your time today, and I'll talk to you again soon. Take care. Bye-bye.